So I think right now the broader US stock market largely hinges upon two major sectors of the S&P 500. One of them is technology, and within that, semiconductor stocks. And second is consumer discretionary stocks. And I'm going to show you guys how this looks right now and why these are so important, these two parts of the market to watch right now. One of the big deals I make to my clients every single day, in part using the market rover, which I'll show you in a second, is to understand how large a weighing that any given stock you're looking at has in its respective group or industry sector, or sector I should say, and also how a big a weighing that any given sector you're considering looking at has of the broader market. So the way we do this, using the market rover, we look up here in the surges, industries, sectors, and groups, and you can see that consumer discretionary stocks are making up about 10% of the S&P 500 right now. Technology, about 21%. So you take those two together and you've got 21% of the S&P 500. Now, and this is where it gets really interesting. So let me move over to this chart here. What this chart is I took both of those two sectors. So if you want to know the ETFs, the one ETF for technology is the XLK, and the other one is XLY for consumer discretionary. What's unique about these two sectors, if you will, is that they are now right back to where they were previously at the all-time highs of 2018. So these two parts of the market, I mean, the whole market looks like this, but not every sector looks like this. So if you look at other parts of the market, like for example, financial stocks, energy, industrial stocks, very importantly, they don't look like these two sectors do. They're all lagging. They're all significantly or notably below their 2018 highs. So I think right now it's really important to watch these two parts of the market. If the large cap technology stocks start to reverse here, I think the broad market will reverse too. My base case, to be honest with you, is more so that we're going to see a stalling of the market. So if you look at this chart here, I'm not necessarily sure we have what it takes to really fall apart. But anything from a 5 to 7, 8, 9% sort of swing to the downside and then just kind of trotting back and forth is really kind of my base case right now. So I hope this is helpful, folks. Again, gaining that perspective in the market is everything, and that's why we use the market rover. You can use whatever tool you want, but this is a beautiful tool that has it all built in. So you know exactly what's going on day to day, which parts of the market are bullish, bearish, in which time frame on an individual stock basis, when these trades happen based on what's happening in the sector. There's pop-up trade alerts and the whole thing, and everything you need to make money in the market. If you're interested in the market rover, give us a comment down below. We will continuously show it here and show you the trade ideas and the alerts that it gives us. I'll always give you examples of that, and it's just a repeatable process. And more than anything, what a tool like that is there for is to really instill a process in your trading and investing. Most people have no process. Most people are being pitched a tool of some sort, in other words, like a charting pattern or an indicator, and that's fine. But unless you use that within the context of a repeatable process, it really doesn't help a heck of a lot. So if you have any comments or questions on the market rover, leave us a link, a comment down below, or send us an email, support@thesteadytrader.com. Have a great weekend. I'll talk to you soon.